Hello, and welcome to this latest edition of Equital Conversations. My name is Gerald Ashley, and I'm joined as usual by my friend and colleague, George Cooper. Today, we're going to focus on the almighty dollar and the idea of the recent events around Trump and the tariffs. Is this going to shake the role of the US dollar as a reserve currency? And it's worth reminding ourselves that the US dollar has been pretty much in the driving seat since 1944 and Bretton Woods. There have certainly been some large bumps in the road since. But now, is the big picture really starting to turn? A difficult question. So at this point, I shall hand over to George.
Morning, Gerald. There's a few things that have happened during this, what I've started to call the tariff tantrum. There's a few things that have happened that I think are quite indicative of the dollar starting to have a few serious problems. One of them, just on Friday, we had the situation where the dollar weakened sharply, even while US bond yields rose. And that was a sort of break in the normal relationship.
That's pretty unusual, really,
yeah,
isn't it?
It has happened before, but this was a particularly big break. And dare I say it, you do get that behavior in other markets, but it's consistent more with what happens with emerging markets rather than with the reserve currency.
I'm going to have to stop you there because that's a kind of a huge statement to sort of suggest that the US is US dollar is not performing normally, and secondly, that it's becoming a much more volatile and skittish currency.
Yeah, yes. I mean, I don't make that comparison lightly, but you see it, for example, with currencies like the Turkish lira, when the market starts to worry about whether the Turkish government can fund its debt, so bond yields go higher, and for exactly the same reason, the currency weakens. And I think this is what we're starting to sense with the US Treasury market. We know we've got a very high US fiscal deficit. I think the federal deficit is currently running at about 8.8% of GDP, which is that's consistent with the sort of level of deficit that was required to deal with the global financial crisis.
Yeah, and we're kind of in the danger zone in that sense.
Yeah, so we are running at serious crisis level in the deficit at a time when we think the economy is performing quite normally. So if we ask ourselves the sort of counterfactual, what sort of deficit level is going to be necessary if we do go into a bigger crisis? Are we going to be at, I don't know, 16% of GDP? Something really, really huge. And I think that's coming at a time when Trump has arguably, let's say, discouraged the natural buyers of treasuries.
Well, I was going to suggest he's upended everything. I may feel slightly calmer in my views and assessment a week than, say, a week ago. But the rules of the game do not seem so solid. It might just be worth just very briefly looking over the last 75 years. As I mentioned, we had Bretton Woods in 1944, currencies pegged to the dollar and convertible into gold. And of course, I'm sure we'll come on to gold in a few minutes' time. Nixon effectively was forced off that relationship with gold in 1971. I think the costs of the Vietnam War and costs in general were just too much. The system then has worked, but it hasn't been perfect, has it? Because we've had a number of shocks in just the world of currencies, two or three big realignments of the dollar against other currencies. But where we are now, it would be a significant step change to say that the US dollar is just going to be another currency?
Yeah, it would be huge. I mean, it would upend all of the sort of norms of financial markets that we've all grown up with. I mean, if we go back to 1971, when Nixon effectively took the world off the gold standard, as it turned out, he took the world off the gold standard, but he put it on to the dollar standard. So the dollar actually became even more important after 1971. And what I'm now wondering is, has Trump now taken the world off the dollar standard, and we're going to go to something else? That something else is, well, at the moment, it's difficult to see what it could be.
Well, I wonder if, like a lot of things in life, they don't end with a bang, but they end with a whimper. And if we look at the history of sterling as a reserve currency, it went from being a very profitable exercise. I mean, we should point out that um, there are a lot of benefits of reserve currency status, normally lower borrowing costs. This wonderful old medieval word, seigniorage, I think I'm pronouncing that correctly,
Yeah.
which is basically you make money from printing your own currency. And nobody gives that up lightly. But over time, and this happened with Britain, the reserve currency status became a huge burden because our economy was not big enough, and we were left with the so-called sterling area, and it was a kind of stuck around our necks. I I would suggest that we're not at anywhere near that stage yet, but it's maybe we should say, peak dollar as a reserve currency has happened.
Well, I think pretty much everybody in the financial markets have got a fair amount of criticism of the handling of the tariff event in the last few weeks. But to give Donald Trump some credit, I think he has correctly identified the cost of being the reserve currency, and that is, over time, it does exactly what you say, Gerald. It helps you, it keeps the currency strong, it lowers your borrowing costs. But because it keeps the currency strong, it also makes you uncompetitive for your manufacturing industries. So, effectively, one of the benefits of being the reserve currency is that the rest of the world manufactures for you and gives you the goods, and in return, you give them printed money.
Yeah.
So, that's, in a sense, that's a great deal. You get stuff for free.
It does sound a very good deal, I must say.
Yeah, it's more or less for free. You can think of it as, I don't know, sort of the king getting his tributes. But over time, that does mean that your industrial strength decays, and it sort of has a natural lifetime because you only get to keep the reserve currency status by being economically dominant, and frankly, what comes with the economic dominance, military dominance. And if the reserve currency status erodes the economic dominance, then it sort of comes to a natural end. And I think Trump has effectively recognized that. He can see that the depletion of American manufacturing and industry has now gone too far, and it's no longer, so America isn't the economic dominant partner anymore. And that means you start to question whether it can be the military dominant partner.
I'm always proud to parallels, and I'm going to do this again. This is a little bit like the UK at the turn into the 20th century. Germany became a rising military and industrial power, and the United States saw unbelievable economic and industrial growth after the American Civil War, and that pretty much by the time of the First World War, the UK was, in retrospect, was probably starting in relative terms to slip back, and then you could take the view that it's slid for 100 years in one way or another. And obviously, it wasn't Germany that emerged, but again, I think simply because of the size of the American economy, it was pretty clear by the 1920s that the United States was going to pick up the baton, if you like, of a reserve currency. Now, we're talking decades there. And I know there is a tendency for guys like us who look at financial markets in minute detail to sometimes compress timeframes. But we might be talking about a very long time here before the dollar slips away, or what do you sense?
Look, it's not going to happen overnight. It's still very clear that the US is the most important currency. I think it's no longer clear that the US is the most important economy. I think that has changed in the last few days, frankly.
That's very interesting. Yeah.
The fact that President Trump has had to pull back on the tariffs against China on a lot of the goods, whereas China could, more or less just sit quietly and wait for events to unfold. That's an important psychological shift. In fact, one of the guys in the office last week made a very interesting comparison. He said what we've just seen is the equivalent for the US of the Suez crisis for Britain.
Interesting.
Clearly they were very different events, but the Suez crisis for Britain was, I think, in a lot of people's minds, the moment at which you realized Britain is no longer a dominant superpower.
The game was up, basically.
Yeah. And so he drew that parallel, which had me sort of, it caused me to sort of pause, think, is that right? Is that a valid parallel or not?
Well, I think if we look at the current situation, the numbers still favor the US in terms of trade dominance. I picked up some data before doing this podcast, and around 86% of all international transactions are settled in dollars. As we know, it's still the primary currency for commodities. One always thinks of oil being priced in dollars, etc. And I don't know if we should just alight upon the view that US Treasury securities are seen as the safest assets globally. Lots of foreign holders. People always talk a lot about what percentage of holding is actually held by the Chinese. And the US needs to issue a lot of paper, it needs to issue a lot of debt constantly. And I think I have the number right that over the next year or so, they've got to refund or refinance somewhere around $3 trillion US dollars. And that is going to be the short-term thing that's going to focus everybody's attention, I would have thought.
Yeah, I think the financial position of the US government is now front and center. And there's a few things that have caught my attention lately. The first thing is the DOGE program, the Department of Government Efficiency. It looks like it's not succeeding. If you look at the run rate of government spending in Trump's presidency versus Biden, it looks like the Trump government is actually spending slightly faster, slightly more than the previous administration.
And that's despite all the ballyhoo and great newspaper headlines of fraudulent activity, which against the full scale of spending is probably quite a small percentage.
Yeah, so it's gone from an expectation of saving, I think the original claim was 2 trillion down to 1 trillion, and now it's claiming It looks like it's going to be maybe a few hundred million.
Billion.
Sorry, billion.
Yeah, we've given up with millions, George.
Yeah. And on the other side of it, the US government has just approved a $1 trillion defense budget. So that's a big step up. I think the previous one was 892 billion.
And of course, that trillion number is pretty much where the interest bill is as well.
There's the interest bill, absolutely, which is, again, after last week, is just getting higher and higher. So all of these things are sort of stacking up to being a problem. At the same time, President Trump has discouraged the buyers of treasuries. Let's put it that way. I'm trying to be as polite as possible. He's certainly made it less appealing to hold treasuries as an asset from a geopolitical point of view. He's also effectively saying, with his focus on trade, and here it's not a criticism of his focus on trade, because I think he has to do it. But in focusing on trade and saying he doesn't want trade deficits with other countries, he's effectively saying he needs a weaker dollar.
Yeah, absolutely.
So if you're going to buy treasuries with a big government deficit and an expectation of a weakening dollar, well, what are you getting for your money?
Well, you're getting a kind of instant markdown if you're not very careful.
Yeah. So, yeah, and all of this, you put it all together, and the one asset that now everybody's suddenly talking about, gold. Gold is effectively the measure of what's going on here. The gold is saying, hang on, we have a problem in the fiscal situation of the US. And I should say, it's not just the US. It's pretty much all not even Western. It's all developed economies have this problem, which is why I think you're right, Gerald. The US dollar will still be the most important currency in several years' time, because frankly, the rest of them have similar problems.
Yeah, and so unlike my earlier historical analogy, the rising economy being strong in the form of the US versus sterling, there isn't anybody to obviously fill the gap. I mean, there are lots of people bang the drum of, well, now is the time for some realignment of all this sort of currency regime. Some people have advocated the idea that the BRICS are going to go off and have some sort of informal currency arrangement, or at the very least, they're going to not boycott the dollar, but they're going to downgrade how much they use the dollar in their trade. As ever in these things, I think it's always useful to see what people do rather than what they say. And I mean, to me, the BRICS are not really particularly enamored of one another. It's just that they would like the idea of the dollar not being so dominant. Perhaps I should just have said BRICS is the term that was coined, I think, 20 years ago by Goldman's, of Brazil, Russia, India, China, and I think the S is South Africa, and
I think you're right. Yeah,
I can't imagine why they included that, to be honest. But there we are.
So
it's a simple mnemonic for how to look at those countries. But the big boys are obviously China and India. But I don't see them getting together to try and replace the dollar.
No, I would agree. The BRICS is not really a natural geopolitical unit, but it's the members of the BRICS and others are being effectively corralled together in part by the behavior of America. I mean, as I think I've said before, when you get to the point when you've peed off Canada, you've got to be working pretty hard.
And they're pretty mild-mannered vote by all accounts.
Yeah, when Canada and Denmark are annoyed, then you've got to. I think you've got to actually step back and say what's going on here.
Now, if we're running the US administration, we've got a very difficult circle to square, if that's the correct way of putting it. We'd like maybe for the dollar to be weaker, but we've got to somehow fund all this expenditure. The yield curve is our enemy in the sense it's going the wrong way. That the long end is saying borrowing costs are going to go up, and the interest rate bill is going to go up, and this is going to make it even harder to cut expenditure. So, to use the well-worn phrase, what's going to give?
The Fed's balance sheet, I think. I think in this situation, the Fed has to become the buyer of maybe first and last resort for the Treasury market. So I think ultimately we're going to be looking at more quantitative easing. Potentially,
so we're back to 2010, 11, 12 again in that sense, do you think?
Yeah, I think so. Probably in bigger size, and maybe that will come with some more exotic flavors of QE, like the Operation Twist, where they try to bring the long end of the bond market down.
Yeah.
Which they can do. They could do with direct purchases, or they can do with effectively threatened purchases. They can say, right, we'll sit on the bid above 5% yield or something like that. And then, if they do that right, they might get away without actually needing to buy that many treasuries because the market won't try to push the yields above anyway.
It'll be known as effectively a put option again.
But I think in the end, it looks like it's going to be an operation. It's going to be a quantitative easing operation that's needed, and of course, we use words like quantitative easing because they're a lovely euphemism. The real word is monetization. That's what it means. The governments are going to be printing money to pay their bills, and that's going to be, I think, it's going to continue to push other safe haven assets higher, like gold. Who knows? It could even carry on supporting Bitcoin. In fact, we should have a little discussion on Bitcoin and stable coins, because I think they're an interesting little sideshow to this.
I'm going to hit the pause button before you get to that and say that. So we're going to see interest rates fall quite a great deal, the short end. Do you think?
I would expect so. Yes. And that's going to be a challenge because.
Well, with the background, I was just going to say, with the background of inflation where it is, that's good.
Yeah, it may. Inflation, I can tell myself plausible stories that sends inflation in both directions here. The tariffs, as enacted originally, were clearly going to be inflationary. But because he's pulled back on a lot of the tariff threats and probably damaged investment spending and confidence, you could actually see a sort of disinflationary impetus coming out of this. And what nobody has been focusing on during the last couple of weeks, or haven't really focused on as much as they should, is the oil prices has fallen very sharply. So that's a disinflationary thing. So,
sure.
There may be a more orderly sort of escape path here, that inflation falls, and that gives the Fed the fig leaf to cut rates, and then I think even by cutting rates, though, they're still going to have to end up monetizing. So I can see that as a sort of.
And then we're faced with the longer term challenge of getting off QE and another inflationary bubble that will pop up as a result, I would imagine.
Yeah, I mean, I suspect that's just another round of QE is just another stepping stone towards dealing with the bigger challenge, which is ultimately governments have to get their deficits, they have to get their spending back in line with their income.
Yeah.
And I find, as somebody who likes to sort of observe the different tribes of economists coming in and out of fashion, one of the things that has amused me in the last couple of months is how you just don't hear from the MMT people anymore.
Oh no, the magic money tree stuff.
Yeah,
the
modern monetary theorists.
I prefer my description.
Yeah, the magic money tree people who've been telling us for years that governments can spend an unlimited amount of money, deficits don't matter, and you don't need to tax to fund your deficit. Suddenly, they've vanished from the narrative.
But yeah, I mean, no doubt there are cycles in these things, and they will come back. I slightly cut you off on the idea of talking about bitcoins and stable coins, and in this last few minutes of us observing the overall landscape of things, just as an outsider on this, well, Bitcoin fell a great deal. It was more like an equity than as a currency.
Yeah, Bitcoin sometimes trades like a sort of leveraged version of the Nasdaq, and I think that's sort of how it's behaved this time. But the part of the digital currencies that interests me more than Bitcoin is actually the stable coins, because I think there's an interesting sort of element to the stable coins,
which is basically they're backed by a dollar. Somewhere behind the coin there's a dollar.
Yeah, I think what's happening with the stable coins, and this explains why they're getting a sort of tacit approval from authorities, is if you dig into what you're buying when you buy a stable coin, most of the time what you're buying is a US Treasury stable dollar fund. So you're buying a US money market fund that invests in treasuries.
And it's got a nice, sexy crypto wrap around it.
Exactly. So what stable coins do is they turn probably the dullest investment in financial markets, which are T-bills, into something sexy. It's a brilliant, brilliant marketing exercise. It's a sort of
and very successful by all accounts. The issuance has been huge.
Yeah. So there's a lot of things, a lot of steps taken by the administration recently. Tariffs is one, the Doge program is another. Telling Europe it wants to reduce its military presence in Europe. They're all consistent with a recognition that the US needs to get its spending down. And I think the promotion of digital currencies, of cryptocurrency, and especially of stable coins, that's very consistent with them looking for a way of effectively marketing treasuries.
As you say, traditionally, or maybe the traditional selling elements have been weakened because we talked about the value of the dollar and the overall performance of the US vis-a-vis China. We're kind of coming towards the end of this sort of run round what may be the start of a whole new era in finance. I think we both agree if it is the start, there will be decades of change to come. This isn't something that's all going to be settled by the summer. Having looked at all that goes on, we're now left with our last little final section. We always talk about books to recommend. I'm going to go first with a book that I was given as a gift last year and wasn't aware of, but I really, really like this financial book. It's called Money and Promises. It's by an Italian, Paolo Zanoni, who's something of a polymath. He's a serious academic, but has had a strong career in investment banking and also in Italian industry. And he just explains in very, very simple terms how banks get created, how they create credit, how this helps economies, and how ultimately banks can be very dangerous institutions if they're not properly regulated and watched. He starts with looking at the ledger entries of a bank from medieval Pisa, actual documents of early entries. From memory, I think there's something like 24 or 25 initial entries in this ledger that has been saved from all those centuries. And it just illustrates how banks essentially create what Keynes would have called bank money or credit. It's a very easy read. It's not remotely technical. People who like financial history, like myself, will really like it, but it's pretty good for the general reader. I'll leave you with the second recommendation to wind us up with, George.
Okay. Well, Gerald, I'm going to go with one of my favorite behavioral books, if you like, analysis of human behavior. And that's a book called Deceit and Self-Deception by Robert Trivers. This book I find really interesting because what Robert Trivers explains is how and why we lie to ourselves. And he explains it in great detail, explains how there are some very important evolutionary advantages to lying to ourselves. So we don't actually know it. We don't know that we're lying to ourselves. But to be more precise, he explains that sometimes we may know something to be true, but we bury it in our subconscious and sort of believe a lie in our conscious thinking. And the reason for that is if we consciously believe the lie, it helps us deceive others.
So there's a comparative advantage.
Yes, and that can be useful. So if for example we've been dishonest there and we convince ourselves we haven't been, then we can effectively get away with it more easily. So we tell ourselves we've been honest. But the research, because he's a serious academic, this guy, but the research he describes is fascinating. But he's also got a few really useful sort of tidbits in there on how you can tell if you're being lied to.
Oh, right. Oh, this does sound good.
Yeah, so that's kind of useful. So one of the things he points out is lying requires more thinking than telling the truth. So you get a higher, what he calls cognitive load. You have to think about what you're saying when you're lying.
It's the old phrase that liars need good memories as well, isn't
Yeah.
it? Mm.
And he said, and one of the symptoms of that is contrary to popular belief. One of the things we do when we're lying is we tend to blink less because we're concentrating so much on the process of lying. So yeah, well worth a read. Interesting book.
Yeah. So your hot tip is if you're lying is to make sure you keep blinking.
Yes.
To counteract the body signals. George, thank you very much. We've covered a lot, I think, in the last half an hour or so. And there's plenty going on in the world, so we'll have plenty to talk to at future episodes. But for now, it's goodbye for me.
And goodbye from me. I'm sure we'll be revisiting this topic again in the not too distant future. Thank you, Gerald.
Thank you.